If you're an investor, chances are you've seen names like Ares Management pop up. They are absolute giants in the financial world, but they operate in a space that can feel, well, a little complicated. So today, we're going to peel back the curtain and break down exactly what Ares does, how they make their money, and what it all means from an investor's point of view. To even begin to understand Ares, you have to start with the sheer scale we're talking about. The company manages a mind-boggling amount of money, over $500 billion. Yep, that's $572 billion in what's known as assets under management, or AUM. A number this big puts them in the absolute top tier of global investment firms.
But look, a huge number is one thing. The real questions for any of us as investors are pretty simple, right? How does that massive pile of assets actually translate into revenue and profit? What are the arguments for buying the stock? And maybe more importantly, what are the risks you need to be watching out for? That's exactly what we're going to unpack. We'll kick things off with the basics of what Ares is, then we'll get into the nitty-gritty of their business model. After that, we'll lay out the bull case versus the bear case side by side, and we'll wrap it all up with a simple checklist of what you should be watching. All right, so first things first, what even is Ares Management? At its heart, Ares is a global alternative investment manager. Now, that's really just a fancy way of saying they invest in things outside of the usual public stock and bond markets. So think private companies, real estate, big infrastructure projects. But listen, the most important word on this slide, by far, is the first one, credit. The credit group is the absolute cornerstone of their business. It's the lion's share of their assets. They are a massive lender to companies, stepping right into a role that big banks have been backing away from for years. Okay, so they manage a boatload of money, but how does that actually turn into profit? This is where the business model itself really starts to get interesting. Now take a look at this chart. That big blue slice of the pie is everything. Nearly 60% of Ares's revenue comes from management fees. These are stable, recurring fees they charge just for managing their clients' capital. This is the predictable bedrock of the entire company. And this slide, this is perfect. It really breaks down the two engines driving this thing. You've got management fees, which are like a subscription service. They just keep coming in, quarter after quarter, providing incredible stability. And then you have performance fees. Think of these as the high upside bonus. They get paid this when they sell an investment for a huge profit. But as you can guess, that income is lumpy and really depends on a healthy market for things like IPOs and company buyouts. So here's the crucial point. What makes those management fees so sticky? Well, a staggering 95% of them come from funds that are either perpetual, meaning they last forever, or are very long-term. This isn't capital that's just coming and going every year. It's locked in. And that creates this incredibly reliable, almost annuity-like income stream that investors, for obvious reasons, absolutely love to see. And get this, that stability also comes with built-in growth. This number right here, over $822 million, represents potential future annual management fees. It's from money Ares has already raised but hasn't put to work yet. It's often called shadow AUM. Think of it like a growth engine that's already built, just waiting for them to turn the key. As they deploy that capital, it automatically starts generating fees. It gives you a really clear preview of future growth. So you can see how that powerful, fee-based model is the foundation for the bull case, right? So let's dig into the key arguments for why you'd be optimistic about Aria's future. The bulls will point to this powerful flywheel effect. First, their dominance in private credit puts them right in the middle of a massive long-term shift in finance. Second, their base of what's called perpetual capital is exploding. It's now over $166 billion, which makes their earnings more stable and predictable every single year. And third, and this is a big one, they're aggressively expanding into the wealth channel, creating products for individual investors like you and me. This opens up a market that's estimated to be worth a whopping $80 trillion. And you don't have to take my word for it. The proof is right here in the numbers. Just look at the acceleration in their asset growth. During a time when raising money has been really tough for smaller firms, Ares is actually growing faster. This points to what a lot of people are calling a flight to quality, where the biggest and most trusted names are just gobbling up market share. All right, but it's not all sunshine and rainbows. No investment is a sure thing. To make a smart decision, you have to understand the other side of the coin. So what are the headwinds that could really slow Ares down? The bear case really boils down to four main risks. First, the economy. A bad recession could cause more companies to default on their loans and just generally hurt investment values. Second, those performance fees are completely at the mercy of the markets. If the IPO and M&A markets freeze up, that high upside revenue stream just dries up. Third, you've always got regulatory risk, from more SEC oversight to potential changes in how performance fees get taxed. And finally, there's the law of large numbers. The bigger you get, the harder it is to find enough great deals to keep putting up those same stellar returns. And this quote right here, it just hammers home that market risk. Those big, lumpy performance fees are fantastic when they hit, but when the exit environment is closed, it creates a real drag on the cash they can actually give back to shareholders. It is, without a doubt, the most unpredictable part of their business. So let's pull all of this together. We've heard the good, we've heard the bad. How should you, as an investor, weigh these competing arguments, and what should you be looking for?
So here you have it, side by side. It's a classic tug of war. The bull case is a story of long-term secular growth, driven by private credit and an increasingly stable subscription-like fee base. The bear case is a story of cyclical risk, sensitivity to the economy, volatile performance fees, and the constant threats of competition and regulation. The whole debate comes down to this: which one of these forces is going to win out over the long term? If you're going to follow Aries, these are the 5 metrics that really matter. In every quarterly report, look for strong net inflows of new money. That's the lifeblood. Track how quickly they deploy that shadow AUM. Focus on fee-related earnings, or FRE. That's the profit from those stable management fees. It's your best look at the core health of the business. And finally, keep an eye on realization activity and the growth of that all-important perpetual capital. These will tell you if the bull case is actually playing out.
So in the end, it really all boils down to a battle between stability and volatility. Eris has built a truly formidable subscription-like engine of stable management fees. But that engine operates in a world of unpredictable market cycles that can either supercharge or stall out its high upside performance earnings. For any investor, the central question is this: is that stable engine powerful enough to drive consistent returns, right through the middle of any storm the market throws at it?